Thanks, everybody. I wanted to thank Nasdaq and IPO Edge for hosting us. Our panel, we have three CFOs. ICR's had the pleasure to work with on IPOs before. I'm Don Duffy. I co-run the firm. As a firm, we work on about 25 to 30% of all the IPOs in a given year. And what I would like to do is ask Isabel, Mark, and Jeff to maybe introduce themselves, and then we'll get into, as CFOs, they were on the front line of defense on getting transactions done. So I think some great insights into the topics today. So maybe, Isabel, you want to introduce yourself?
Sure. Isabel Winkles. I'm the Chief Financial Officer at Braze. We were founded in 2011. We're a marketing software platform that helps brands engage with their end users through omni-channel digital marketing. We went public in the tail end of 2021. It was my first CFO role and my first IPO. We definitely top-ticked the market, going public right at the beginning of November 2021, and have now been living life as a public company for the last almost 2.5 years.
And I'm Jeff Utz. I currently am the CFO of Kura Sushi USA. We have 63 restaurants in 17 states and DC. We're traded on Nasdaq. We went public in 2019. I joined the company 3 years post-IPO in 2022. However, my previous role was at Shake Shack, and I was there for that IPO, which we did in 2015. That trades on the other stock exchange, which we won't mention here. But so I've been in the public world for about 10 years and worked closely with Don and the ICR team over those 10 years, and we've really enjoyed being part of the ICR world.
Hi, I'm Mark Schiffke. I'm presently the CFO of DCG, which invests in cryptocurrency and blockchain assets and companies. We're private, but prior to that, I was a public company CFO at Billtrust, where we worked a lot with Don and ICR and going public in January of 2021. And prior to that, I was a CFO of Green Dot, also a publicly traded company, where I helped take it public as an investor and at the investment bank I was working at the time.
Well, thanks. Let's jump right into it. Isabel, you were CFO, I think, for less than 2 years by the time you did your IPO. So when you landed there, maybe you can share with the audience a little bit about kind of you landed, what the time frame was, what the runway looked like, and what was some of the key areas you felt like you needed to address when you got into the CFO seat?
Yeah, so when I started, I think management and the board's idea was that we were 12 to maybe 15 months away from an IPO. And I started asking some questions, and I remember our CEO would say to me, yeah, it's great. Our contracts are super simple, and everything's totally automated. And the automation was true to a certain degree for a lot of our operating metrics. You could pull up a bunch of dashboards and see a lot of real-time numbers that were relevant to the business. It was totally not true for things that were relevant for filing GAAP financials. And so the more I sort of ripped things apart, and I'm not a CPA, so I had to really depend on our audit firm and other sort of special experts to help me. We used the Connor Group as sort of additional arms and legs on the process. And I was told, no, your contracts are super, super complicated. The ability to adhere to ASC 606 revenue accounting standards was like really, really tough. We were doing everything manually. We were doing everything in spreadsheets, and I was like, okay, so we need to resolve this. And I ended up having to have some pretty tough conversations with the board and brought our audit company along with us. We use EY to sort of help explain where we really were. Finance broadly, when I arrived, I had 20 people under me and 2 CPAs, which is not what you need to live life as a public company. And I think we really had to change the company's view on finance's role in the process. So I had to materially enhance and increase the skill sets on the team. So it's people, process, and systems. So I had to get a lot more of the right people. I had to put in all the right systems and checks and balances in place. I remember our CEO said at one point, he's like, yeah, we've been super efficient. I managed to avoid hiring a contract data entry specialist and a contract data checker. And I go, and that's why we are going public with 3 material weaknesses. So there's a lot of perceived inefficiency in finance, but really it's actually good governance. And then we had to put a lot of systems in place. We implemented Zora Financial to help us with automating our revenue recognition process. Now I can get revenue in 2 days, which is incredible when we're closing the books on a monthly basis. And so just recognizing what it's like to live on that 13-week hamster wheel. I had to do a lot of learning myself because I'm not a CPA, but I know about large, complex, can't-fail processes. And so that was what the skill set that I used to try and get the company ready, and then just having to explain to both management and the board where things really were and the investment that was required to get us ready.
Jeff, you,
No, yeah, good.
I was just going to say, Jeff, Shake Shack was getting carved out of Union Square Hospitality Group, which was Danny Meyer's business, and you got there, you landed in the seat. I suspect they probably didn't tell you we're going public in a couple of years because of the small amount of restaurants you had. But when they said go, what were you thinking, and organizationally, what did you have to address?
So I joined Shake Shack in September of 2013, and we had a private equity sponsor, so I knew there would be an exit at some point. Didn't know what it would be, didn't know what the timing was. They didn't bring me in to do an IPO. However, the following board meeting, May of 2014, the board decided we're going public. And Jeff, I want you to have the S-1 filed in September. This was in May. So I had 4 months essentially to get ready for the IPO. We had to do 3 years of audit because we were using a firm. When EY came in, they weren't going to rely on the financials, so they had to go back and re-audit 3 years. So I started to have to think about what do I need in terms of readiness, in terms of be prepared. SOX, we may get into that a little bit later, but be prepared for SOX because even though you don't have to be 404B compliant for 5 years, that 5 years comes super fast. And identifying your significant deficiencies or material weaknesses, if you have them, up front, and making sure you bring in the right people to help mitigate those before you get up against that 404B compliance is important. So we filed our S-1 in September, and at that point, the 3 positions that I felt that I needed were a director of external reporting, or SEC reporting, a director of tax, and a director of internal audit. And in my opinion, the director of internal audit, because she handled all the SOX readiness, was the most important hire that we did. So a bit of advice would be, if you're thinking going public, that's why you're here, of course, make sure you have your internal control processes completely under control before you're up against that deadline.
And Mark, I thought you might have had the record for shortest time period, but you landed at Bill Trust, and 8 months later you were going public through a SPAC transaction, I believe. But maybe what you knew walking in, and then what you had to prepare for in that short window, getting that transaction done.
I would say my experiences are very similar to Isabel and Jeff's. I got to Bill Trust and thought we had a sort of a 2-year path towards going public, but that was in January of 2020, and by May of 2020, even late April, it was clear the markets were on fire. And so we pivoted very quickly, having no PCAOB audits. Like we were standing still and maybe a little negative, I don't know. And we made the decision in May, June timeframe, and by January the following year, we were public. I think our experiences were very similar to what you all described. Just to add something a little bit different, elaborate on what you said. We relied heavily on outside advisors, in part to help our small team get everything done to be PCAOB compliant. Use that process in part to get a better sense of how strong my team was, where our weaknesses were. Brought in outside advisors to help us understand. We actually were going to have less than a full year to be SOX compliant, going from January to December of 2021. And so we started that process pretty quickly, almost simultaneously with all the efforts of going public, to understand who some of the key hires would have to be, what some of the key processes would have to be as we went public. And then spent time looking outside of finance into the rest of the organization, going back to Isabel's point on key people, processes, systems, to see where weaknesses might crop up, what had to get fixed before we were public, what we could fix after we were public, and helping the organization understand the difference between casual sharing of information in a private setting and what could be MNPI shared at our sort of monthly all hands meetings, and just getting the organization to think more about what it would be like to be in a public setting.
So, Jeff, we just heard on a couple of panels ago, the IPO market is thawing a little bit. ICR certainly sees it that way. There's a lot more activity out there. If you're a CFO sitting in the seat and your venture capital firm or private equity firm starts talking in the next board meeting about you need to be ready in 12 to 18 months, what other advice would you offer to people sitting there that beyond what each of the panelists just talked about as they think about being prepared? Because certainly we feel like 25 is going to be a better year than 24. 24 is picking up. But any other input you would offer to our audience?
I mean, I would just elaborate on what I said about internal controls. Make sure that your internal controls are completely dialed in, because material weakness or even a significant deficiency takes quite some time to iron out. You have to have 2 consecutive quarters of no material weaknesses before you can before a 4B compliant. So, like I said, that comes super quick if you're not ready. The other things that I would echo, and a couple of the prior panelists said this, is the forecasting side of things, because everybody wants to know what's your business going to do in the future. So you have your budget and you have your forecast, and I look at them as 2 completely different things. You set your budget at the beginning of the year, and then your forecast is based on what you've done. So for my business, because we have sales every day, I update our forecast nearly daily based on the sales trends that happened the day before. So almost every morning when I get our sales numbers, I sit down and I update my model going forward. And I would start treating your business that way. Make sure you know what your business is going to do. Start thinking about what kind of guidance you're going to give to the analysts, because you're going to be held accountable to that. And the best thing that you can do as a public company is keep your promise to the street. So if you choose things that you know you're very comfortable with to give guidance to, for instance, I give guidance on sales, our G&A percentage as a percentage of sales, and then how many restaurants we're going to open in a year. Could potentially widen that a little bit and keep getting asked about it, but right now that's what we give, and those are things that I'm comfortable giving and things that we've been successful in meeting and keeping our promise to the street. So I would start thinking about what types of things you're going to talk about with the analysts and what you want to drive home and what you're comfortable meeting, because certainly, and you've probably heard this, the first 2 quarters after going public, you don't want to miss. Well, you don't want to miss ever. But you really don't want to miss the first 2 quarters after going public, so it's important that you have those metrics really set up.
Isabel, any thoughts there?
Yeah, so I think big thing for us is being able to think cross-functionally. And so, I think the prior panel talked about sort of the path to IPO and compliance. And I think one of the things that I had to sort of realize was how many other groups around the organization were going to have to deal with this IPO process. So there was a whole path to IPO before I arrived at the company, but it was largely run by other G&A functions. There never had been a CFO sitting in the seat, and we actually lacked a lot of people who had worked at public companies and who really knew what behaviors and things really needed to look like. And so the interface between the technology team or IT team and finance, so we had a significant deficiency in how we did our software capitalization. And the folks who were doing all the engineering work, they didn't know that they had to track hours and do this in a way that was repeatable and scalable and checkable and auditable. And so just getting people to understand what it is like to live life as a public company and to be on this path to SOX 404 compliance. And so just educating the organization, the people team. And so, the people team had a whole bunch of, or HR team had a whole bunch of tasks that they had to do that it's a great group of people, and they are great with dealing with people, but sometimes attention to detail and systems and all of that wasn't really their forte. And so we had to tell them, look, either it has to become something you're really good at, or we're going to move that capability over to a different team. And so I think having some of those conversations and recognizing kind of the cross-functional team sport that it is to live life as a public company, the guidance point is so critical. Even forget about missing guidance, even taking down your guidance for, missing a quarter is really, really bad. But even retrading on something you told the street and saying, oh, sorry, it's not going to be this for the full year, but it's going to be this lower number. And can be really, really hard. And you don't even realize, this came up fast for us. When we sent the model to the analysts, all of a sudden we were in our second year, and now they've got that third year out there. And I was like, I wonder where they got this number from. And I'm like, oh, that was in our model. And so all of this stuff comes back and the analysts they're bright individuals, but in a lot of industries, they really play ball, and they do what the companies tell them. And so you just have to be very, very careful what you tell them, because they listen, they write it down, and they do what you tell them. So that just something to think about over the longer term, because these years, they come up fast. I think Jeff mentioned, 4 years goes really fast. I mean, 2 years goes even faster. And that's where we are in our process. So just be careful what those models look like when you share them with your analysts.
Mark, you had 2 stints in the CFO seat. Any further thoughts there?
Yeah, I think pretty much along the same lines of what you've just heard. I guess adding a little bit more to it is really understanding the numbers. So it's not just that they're right, but understanding what they're telling you about the future. And that will lead you to being a little bit better in guidance and in capital allocation. And the real question that you're solving for is, what can this company become from where it is today? And so with good capital allocation and with understanding trends, and by ignoring averages, and making sure that you're actually seeing all the component pieces that build up to what that aggregate looks like, you'll be in a better position to have that stronger guidance and be a little bit sharper in that capital allocation. And I guess the only other thing I'd say along that is, with my FP&A team, it was always a trust but verify, getting back to what would you have to believe for this to be true, and understanding all the pieces that would build up to it in terms of units sold, costs associated with sales and marketing, to understand that the numbers really are leading towards the conclusions you're drawing.
And Don, if I could just add really quick too, something to remember as a public company CFO or CEO is, you're always on stage. And it doesn't matter where you are and who you're speaking with, everything you say is somebody's going to read into that. And not just the words you say, but your voice inflection, or your body language, your facial expressions. Everything that you say and do is going to be read into, especially by the sell-side analysts. And you want to make sure that you're just very careful when you're talking with anybody, even at lunch with a group of people, what you say, if somebody's sitting next to you and they're listening, because everything you say will be analyzed to the nth degree.
And you will be quoted way more than you are comfortable with.
Usually incorrectly.
Yeah, I always like to say you should act public when you're not. I wasn't on all of your deals, but on the ones I think at Shake Shack we were doing earnings calls as a private company. I mean, start doing them early, get used to it, because you never want your first earnings call to be your first earnings call. Let's stay on the analyst side and the banker side. Maybe you each can comment on how you went about picking the investment bank to lead your transaction, and particularly the book runners, and then the interplay with the analysts. You've each talked about the importance of them. I know a lot of my colleagues like to say you date your banker and marry your analyst. They stay with you as a public company. So, and sometimes you don't want that. You can't divorce them, unfortunately. But maybe you can each talk about that. I'll start with Isabel, and we can go down the line.
Yeah, so we had 3 lead book runners, and we did a formal bake-off, obviously, to get those guys in the door. We felt very comfortable with the analysts, number 1, on all 3 of those banks. So that was sort of threshold number 1. Well, we knew we needed some big bulge brackets. You want the brand names. So there's a subset, of banks that you're going to choose for those top 2 or top 3 spots. But we met with some analysts, and we sort of decided who was sort of capable of being in that sphere. The list was not insignificant, so we did have a number of banks come in and do the bake-off. And in the bake-off process, what was important to us is we definitely thought of this as a dating relationship. We're like, we just need you guys to get us through this IPO process. And then, yes, there's ongoing relationships with the banks after that, but it was like we would cross those bridges when we would get there. And so we really listened to how they retold the story back to us. And we felt that with the banks that we ended up choosing, and at the end of the day, the lead left is the one who did all the work. So we felt really comfortable that we would have a less painful process by using these 3 banks, because we wanted to hold the pen on a lot of the S1, which was what we did, but it was really helpful to have these banks understand what we were about to help us edit and rewrite and give us advice, and so that was great. I will be honest, the rest of the syndicate, there was some brand name recognition, and we got a lot of help from ICR on helping me negotiate the terms with everybody and what the economics were going to be and the sequence of events. I'd never done this before, so super, super helpful to have the team help me through that process. But it was almost exclusively about the quality of the analysts that we were going to get. So we had 12 banks in our syndicate altogether, and our goal was to get the strongest set of analysts who understood the space. It wasn't even really about getting cheerleaders. It was about getting smart individuals who felt that we could teach them and train them. One of the things we had to understand is how confused the market was actually about our company. There is no perfect comp to us now. The best comp that's out there right now is probably Klaviyo that recently went public. We are, so we didn't really have a great comp, and it was hard for people to understand us. So to really get a set of analysts that we felt could dig in and really wanted to learn and could learn was important.
I think our story is a little unique because we were very fortunate to be a New York-based company, and Shake Shack was very iconic in New York. I had the luxury of having the Danny Meyer name behind me when we were looking at banks, and so we had a lot of banks, obviously, that wanted to be in our transaction. We ended up having 7 on the IPO, but because of the interest in Shake Shack, and the banks would say, God, I take my kid, I walk my kid to Madison Square Park every weekend. I've got to be on this deal. My kid loves it, and they would be so happy if we did this deal. So it was really cool to have that that unique atmosphere. But we were also very fortunate that we got a bulge bracket to go on the second line. And which is pretty tough to do, and I think it was because part of the Shake Shack name. But then I will agree with Isabel that the analysts were very important. So once we got past the bulge bracket piece and we started looking at who are the very best analysts in the restaurant business and who are the best bankers, and there's 2 or 3 firms out there where they have really, really good bankers and have really, really good analysts. And that was very important to us as well. And I'm glad that we chose the banks that we did because they understand our business. Because it's very difficult trying to explain your business to someone who is more of a generalist, who doesn't fully understand it exactly. You can get there, but certainly if you have somebody a set of analysts that understands the restaurant business, in my case, the restaurant business, you don't have to school them. You just have to tell them, here's what we're going to do, and they get it. So that was important to us as well. So like I said, our experience was a little unique because of the New York brand and New York base and Danny and everything that goes behind that. But I think what Isabel said, I'll 100% agree with.
Mark, do you want to come? Your transaction was a little bit different because on SPACs, you're really hiring capital markets advisors, but not terribly dissimilar in that you want to make sure you have research coverage.
Yeah, I would say it's very similar in that respect, and the Green Dot IPO is pretty much what they were saying as well. For me, it really is a combination of who's the lead bank, like who do I want to go to war with? You got a certain amount of time to get something really complicated done, and who's going to help you execute that to the extent you can be flawless, as close to that as possible. And that was our lead bank. And then it is all about the analysts. It's those who can understand the business, explain it well to investors, and are well regarded in the market. So that's pretty much how we thought about it. And then we also took advantage of, as we were in a dating process, sort of free advice. So help get a better understanding of the competitive landscape. What are the KPIs other investors look at? Who do they all think the key investors would be in helping this stock be supported? So that was all part of it.
I have one regret in my process that I'm going to use this little platform to share with you, and maybe one of you will fix this, or maybe it's already been fixed. I don't know. So when we were hiring the co-managers, there was this concept of bringing on a diversity co-manager, so an all-women run or persons of color or what have you, and it was they were going to be a sell-side analyst just like everyone else. And I was kind of struck, but sort of felt powerless, and I did the wrong thing, and I wish I had done something different, that the economics that was given, they were on the bottom line with all the rest of the co-managers, and they were in line with, I don't even think they were at the end of the list. I think they were just in alphabetical order. But their economics, the economics that we gave to this diversity financial institution was like less than all the rest of the co-managers. And it sort of struck me after the fact, why? They're doing the same work. Yes, they're the co-managers. Yes, there's a pecking order, and we had 3 tiers. But I always wish I had sort of fought for that and to sort of, look, it's the same work. They should be they're on the same line. They're doing the same job. And if we want to, fix all these things that we talk about in our society on structural racism or structural sexism or whatever you want to call it, then if they're doing the same work, they should be paid the same. So I missed that opportunity. If I ever get the chance to do this again, I would fix that. And if any of you have the chance to fix that, I would applaud that.
One thing, too, I just actually thought of, something you may have to deal with, and certainly I went through, is that depending on the composition of your board and who's on the board, everybody has a favor to pay back when it becomes IPO time. Everybody's got a bank that they owe something to. So don't fall into the trap of choosing a bank that may not be best for your transaction just because one of your board members, I mean, they may force you to, but just because one of your board members owes somebody something. We did have that. It worked out. Turned out good. The Shake Shack IPO was extremely successful. But you could possibly run into that, so be ready.
Yeah, it's interesting, Jeff, if it's not a control company, I mean, we find the private equity and venture community has a very strong opinion on those, and I would say it is important for a management team to kind of call that out, really rank people based on the quality of the firm and what you're looking for on your cover. There was a couple of mentions about the investors. Let's talk a little bit about engagement. That's really what the next panel is about, but maybe your own experiences with investor engagement pre-IPO, how much of that you've done, and then certainly how that relationship pivoted post-IPO and how much of your time was dedicated to it. I'll maybe start with Mark, and we'll go the other way this time.
Sure. We spent a good amount of time with investors pre-going public. Investors have so many things that they see come across their plate, and they have to understand why they should take the time and energy to actually dig in and understand why this investment could be something very exciting, not just today, but over the next 3 to 5 years and beyond. And they don't do that overnight. And so the more you can spend time understanding the story in a way where you can tell it simply, intelligently, and then go to that next level and that next level as they continue to dig in, the better off you are. And so, giving investors that time on the front end is very, very helpful. Then you have to spend time with them afterwards, and it shouldn't be viewed as a chore. They're showing a great deal of confidence in the management team and in the thesis that you're providing, and so it's very important that you initially earn that trust and then maintain that trust.
Yeah, that's a good point. And maintaining a relationship with the investment community, I think, is very important. Before Shake Shack, I was with Yard House Restaurants, and I joined the company when we only had 3 restaurants, and we grew it to 41 and ended up selling it to Darden in 2012. But we ran a dual-track process during that. And we've actually filed an S1, and during the 30-day initial SEC review period was when the M&A bankers struck a deal with Darden. We threw the S1 in the trash, which is a lot of work to throw in the trash. But in any event, my point is, at Yard House, even before, I was already started speaking with investors. Then when I got to Shake Shack, it's the same people. I'm meeting with the same people. Now I'm at Cura, and I've been fortunate enough to have some of the blue chip shareholders come to me and say, we're going to invest in the company because we know you, and you've done what you said you're going to do, and we trust you. So having that relationship and that trust with the investment community before you go public will follow you throughout your career, regardless of where you are.
So I would say start early. A lot of the banks that you're going to develop relationships with or already have relationships will do a number of conferences that are for public and private public and private companies. Attend those, get in front of investors, use it as an opportunity to see what people are confused about. What are they asking about? What are these thematic questions that keep coming up? And then you can use that to write your S1 and all various documentations and plan your roadshow materials, your roadshow video around addressing some of those things. We definitely started early and did that. It was very, very helpful. The other thing that I would say, we didn't get to do this because we went public in the depths of COVID. As much as you can get in front of people in person, do that. So if your IPO if you can be getting on that plane, it's less efficient, it's more tiring, it's more work, it's more expensive, but it will pay dividends. It is very, very helpful to actually physically get in front of people.
Yeah, and I would add, there's no pressure to share a bunch of information. You're still private. So I think it's a good point, though, get feedback, but it's not like you have to put historical financial information. You don't have to share forward-looking information. Leverage the buy side to collect information. Do we have time for questions? Can we go to questions? Any questions from the audience, or I can keep going?
I'll keep going really quick. I'll say
Yeah.
to your point about forecasting and making sure people understand your business, take advantage of Analyst Day right before you go public, because that's a time where you can really tell them pretty much anything and make sure that your business is understood. So when those initial research reports come out that the investment community is going to be relying on to potentially invest in your business, along with conversations with management, make sure that they're accurate, because like I said, you can tell the analysts pretty much anything on when you have your Analyst Day pre-IPO, and that's a very advantageous day to get your story told properly.
Just be clear with them. I was literally just on a call this morning with a company I'm on the board of that was having their analyst Q&A session. Just be very clear with them what you're not going to say again once you're public, like what are the numbers that not to expect again, and what they shouldn't publish. So there is a little bit more of open the kimono, but you just have to be really clear. There's a trust relationship. I'm going to tell you this now. You can talk about it in terms of color and thematically, but these specific items we'd rather you not share.
Hey, great panel. Appreciate your time and your insights. I was just curious, one of the things, spending a lot of my own career on the buy side, when a company goes public, SPACs have historically, I think that's changing because of the safe harbor removal, but SPACs, when a company de-SPACs, they put out forecasts. IPOs companies don't put out forecasts, yet sell-side analysts always have detailed models, and they share them with the street as well. So I'm always been curious, I never knew exactly, how does a CFO work with sell-side analysts in preparing the forecast, and invariably they release roughly 30 days after an IPO?
Yeah, so during the analyst day, ahead of the IPO, the analysts will, all the sell-side analysts that are on the deal, it's a teach-in or whatever you want to call it, they will actually be given a model. We will build a model, and it will be sent as sort of a flat file, so they have to reconstruct it effectively. But it's sort of all the key drivers that drive top line and however much detail you want to give them. But they are given call it a 3-year forecast, and it will have annual and quarterly, and it'll have all 3 financial statements in there. So they are typically, companies do give an outlook, which is why I said in the beginning, be careful what that outlook looks like, because they will listen to it, and absent any new information, they will just hang their hat on that model.
Now, I would just add, we work closely with issuers to collect them, because even though you send the model, it's amazing sometimes the model doesn't look the same that they create. So it's important you collect them. Not every bank before the deal launches will share the model. Sometimes you have to get on the phone to kind of go through that. Some banks have different policies. And then once you launch an IPO, which is you do a Salesforce teach-in, they effectively are now over the wall. So you have to treat them the same as everybody else with regard to material non-public information.
And then also to that point, make sure that you keep the teaching the analysts as you go every quarter. So, our typical quarter, most public companies, we release earnings at 4, then we have our earnings call at 5, and then from 6 to 10, I'm on 15 to 20-minute calls with every sell-side analyst. And I can't tell them anything new. I can't tell them anything different than what we've told the street, but you can help them understand the business better to get the model a little bit more accurate, because they want it to be accurate too. It helps everybody if the models are accurate. It helps the issuer, it helps the banks, it helps the analysts, it helps everybody. It helps the shareholders especially. So make sure that each quarter you keep updating what you expect out of the analysts after your calls.
Any insights into picking a stock exchange, since we're at Nasdaq today, but maybe?
So we went through this. So we're Nasdaq listed. We went through this, and our marketing team actually sort of led the effort on this. And we had all these conversations, and we visited, and we talked, and I think in the end, it sort of came down to like, what can you do for us after the fact? And so we sort of felt like Nasdaq had the best space, the best venue. I think the guys down at the bottom of Manhattan like to talk about kind of their historical cachet and all of that, which is all great. It just wasn't necessarily perfectly aligned with our own brand. And so we love Nasdaq and we're very happily listed here. I think it's a little bit, I'll say it's a little bit of Coke and Pepsi. So I think you could sort of make your decision. Your decision about your banks will be much more critical than this decision. But we were very happy with what we've been able to do other events at Nasdaq. We were really, really happy to be able to have 50 people on stage. That was super special to us. And we could have, almost a huge amount of folks here to celebrate. So Nasdaq definitely made it special and we're really happy we listed here.
Question. As you go through the process pre-IPO, now you're on the other side. Be curious to get your lessons learned on just changes or impact or disruption to the business, whether it's like a cyber attack or social media. You mentioned internal audit as a big area of focus. Just curious, lessons learned in the last couple of years, things maybe you would have done differently, major disruptions that have occurred to the business along those lines, and lessons learned.
I think I've been fortunate. I mean, there's no wood to knock on, I guess, but I haven't had a cybersecurity incident. Or for us, it's what could take down a restaurant company is clearly food safety, right? If we had a foodborne illness outbreak, that's what could cause the biggest problem. But we do have quarterly disaster recovery preparation. We have a committee that goes through what can happen, and if X, Y, Z happens, how are we going to handle it? So again, it all comes back to preparation. The last panel, preparation, I think was part of the name of the readiness, was part of the name of the panel. It's all part of that. And just to make sure that you're not scrambling to figure out what to do. And we have a disaster, the same committee is on call. So if we have anything as simple as, in one of our malls, we had over 2 days before Christmas, the Mall of America, there was a shooting. So we had to have a call at 11 o'clock that night. Are our employees safe? That kind of thing. And so just always make sure you're just prepared for when something happens to know what you're going to do. But like I said, I've been fortunate enough to not have to deal with it. So let's continue hoping.
The biggest thing for us, which was, I would say, it was disruptive on a slower time series, but maybe a little bit unlikely, was with the understanding that people started to develop of ASC 606, the new revenue accounting standards. Our go-to-market motions had to evolve. And some of the things that our salespeople would do and the way they sold and the way they wanted to sell, we sort of looked at these contracts and we're like, these contracts cannot be structured like this anymore. And we had to sort of shift and we had to educate the legal team on, a lot of times the legal team would do things with the best intentions, and they didn't understand that the words that you use matter in the context of revenue recognition, and that the auditors know how to read the legal terms of a contract. And so we had to do a lot of education and kind of shift that, and that was part of why it took us the 2 years to kind of get out after I arrived, and that was a process to go through, and that was, I think, I don't think anybody expected that.
Make sure you're happy with your definition of adjusted EBITDA.
Any other questions? Great. Well, thank you. Thank you, Nasdaq. Thank you, IPO Edge. And thanks to the panelists. We appreciate it.
Thank you.
Thank you.